Hi, good evening, everyone, ladies and gentlemen. Maybe we just give a minute or two just to see if there's any burning questions from the audience to appear in Slido. Let me just kickstart that, and I guess I will direct the first question to William. Right. So I think we have seen the 60-40 asset allocation, 60 equities and 40 fixed income, coming back into prominence. Do you subscribe to this view, and if not, what do you feel it's the most optimal asset allocation?
Well, so one of the issues that we have in the current market environment is that when the Federal Reserve and other central banks dictate so much of what is happening in the markets, bonds and equities sometimes move relatively closely together. So it's relatively difficult to get good diversification. And that's why I think you need to try to get diversification where you can get it. So in the equity market, it means already making sure that you are diversified across geographies, but also across sectors, because I'm telling people that especially those who are business owners, who have a business in a certain country, already have a lot of country risk there, please diversify geographically. In the fixed income markets, we heard one example of that, of diversification possibilities within fixed income. It's not just one block. So when you talk 60-40, make sure that probably those proportions are okay, but within your asset class, be very diversified.
Sure. Thanks, William. And maybe pivoting to James. You spoke a bit about China, and I think it's very relevant to our investors, our customers here. I think we've seen China experiencing soft equity markets performance for the last 3 years. So number one, why is that? Maybe you could perhaps share a bit more insights. And what strategy can an investor who has exposure in China, what can they do?
Yeah, well, I think China has been a difficult investment for many people, really, because you have to really bear in mind that over the last few years, if you think about the last, let's say 2010 and before, China was growing at 9, 10, or even growing extremely fast. Going forward, China's growth would structurally slow, 5%, 4%, 6%, that sort of range. So you have to expect earnings from companies are also going to be lesser, primarily because the structural force that's driving China is really because of demographics. I've explained that earlier. China's population is declining. When China was growing, its population was increasing. Earnings growth, GDP, everything went well. And the reason why you are seeing all these policy measures essentially is trying to address the big issue of this population cliff, whether it's to make housing more affordable, healthcare better for everyone, or even education. So these are the things to essentially address the problems that China was going through. But of course, as with implementation of policy, it's always tricky. It might not hit the policy at the right time. And you see fine-tuning and adjustments, especially in the tech sector, for example, or even in other sectors that the policy had or had influence on. And that's why we saw huge amounts of volatility. And clearly, I think right now the root of the issue would be the property market. It's a difficult issue. At the one hand, you want to reduce the debt in that sector. But on the other hand, you want to make housing affordable to everyone. So it's a balancing act. There are policy measures in place trying to bring that about. It will take time. But of course, markets are impatient. And one of the graphs we show is that foreign investors has been cutting exposure to China. So given this sort of backdrop, what one should do? My message is don't write off China, but it doesn't mean that you're going to get a V-shaped recovery, or you're not going to expect China to double itself in value this year. So I think from that perspective, it's always to be a bit prudent, not to have big concentrated positions in China. I mean, I've spoken about this last year, 2 years ago, to kind of trim down concentrated positions, bring it to a neutral position. And if you hold on to those companies and stocks, make sure those are good companies that can deliver growth in the years ahead. And that's always been my message. And always diversify, build a globally diversified portfolio.
Sure. Thanks, James. Maybe just staying with you for the time being. I see there's a question on currency, so seek for your patience, Alvin. So James, what are the key risks and uncertainties that could derail global and Asia or ASEAN growth in 2024?
Yeah, well, I think in terms of the external environment, it's actually, at least the macro interest rate environment is conducive for Asia and ASEAN. It's a falling interest rate environment. That's positive. It's a tailwind for Asia, tailwind for ASEAN. The risk, of course, is what if that reverse? It could be. Let's say if inflation surges back up again, Fed, instead of pausing or cutting rates, they have to increase interest rates by another 100 basis points, 150 basis points. That would choke up everything. Not our base case, but it's a risk. Of course, another risk would be domestically, election outcomes. You could go either way. It's hard to tell. But from the current reading, in Indonesia's case, it's likely that even the new candidates post-Jokowi would keep the policies intact because it's highly popular. India's case, likewise, from the post-state election, it also looks like policy continuity. So I think from that perspective, I think investors should think about investing in ASEAN and India, because if you wait till all these risks gets cleared out, a good half of the year is over. You can't capture the growth associated with the market. So I think it's very important.
And again, exactly right. Because, if you wait for it, you're going to sit on cash again, miss out again on the opportunities. People have been underestimating, in particular, US growth for a long time. Go back 12 months, people were calling for a recession. They were calling for a recession in the first quarter. Then it became the second quarter. Then it became the third quarter. Then it became the fourth quarter. And they're pushing it out further and further. It's the most anticipated recession, and we're not going to get it in 2024. So, yes, there are risks, but manage them in the portfolio because you don't want to miss the core case. Please invest for the core case, which is a very positive one.
Okay. So there's a key message there, ladies and gentlemen. Now, right, let's move on to currency. So Alvin, if the US dollar will hold its value, how long would it take? And in your opinion, what is the best timing to sell USD?
Well, that is the biggest question that everybody has. Look, I think we touched a bit upon weaker European currencies. So when is the time to hold US dollar and sell? Don't do that against European currencies. So it's really depending on which currency you want to convert into. Certain Asian currencies that I've mentioned earlier should see some relief and gradual recovery. Ringgit is one of them. Sing dollar will remain stable and strong. Renminbi may see a little bit of relief. Japanese yen, that's another currency to keep an eye on because it has been weak. A lot of us have enjoyed cheap holidays in Japan the last 1 year. That's largely because of the widening yield differential between US Treasury and the 10-year JGB bonds. Now, the Treasury yields in US have started coming down fast. And if that continues to be the case in the next 12 months, it will continue to narrow. That should favor the Japanese yen.
Okay, thanks, Alvin. And I guess moving on to Jessica, right? In terms, you spoke about the India fixed income opportunity. I think what do you see as the biggest risk in this asset class? And maybe perhaps you could share a bit more insights on the Indian market, which I believe, in general, most of our customers may not be as familiar. I, for sure, is one. So perhaps maybe just to hear a bit from you.
Well, I guess one of the biggest risks that we see in India is really going to be oil prices, right? Given that if we see a sudden spike in oil prices, that's actually going to affect the inflation as well as negatively impact the India bond market. So that we would have to observe and see where oil prices level are. In terms of the India fixed income market, I've actually shared a little bit on that. But essentially, we manage like I mentioned, a INR onshore India fixed income strategy since 2012. Our approach to investing in this area is to focus on high quality IG space. We look at holding more than 60% in sovereigns. And then within the corporate space, we are looking at very selective in our robust credit selection and to pick bonds that do not default. And that we really focus on the AAA and AA space, where we have seen in the AAA space there hasn't been any default over the last 3 years. And in the double A space, that default rate has been pretty low at around less than 0.3%. And obviously, I think to kind of navigate through the India fixed income market that might not be well known to international investors is really through active management and hold a portfolio of bonds, not just 1 or 2 bonds, but a diversified portfolio of maybe 60 to 80 bonds to kind of diversify the risk. So that's kind of what I want to mention on the how we are approaching investing in India fixed income today.
Sure. So diversification still remains key. We have another question that came in, which is, which countries and sectors will be most affected by the current unrest in the Middle East, considering the likely disruption to global supply chains? I'm not sure whether William or James?
Yeah, the answer to this is European industrials. and I'll talk you through it. Our global research colleagues did some work on this actually, and they calculate that the fact that if your ships from Asia can no longer go through the Suez Canal but have to go around Africa, the Cape of Good Hope, it basically adds about $100 to the cost of a container. But the shipping companies are actually increasing rates much more than that. So a beneficiary may be the shipping industry. So if you then think of China as being the factory of the world, especially in terms of unfinished goods, where they go, they have to go to Europe. So therefore, that is going to be the bottleneck, and the industrials obviously are the ones that are going to suffer most. If you think about the services sector, is not really affected by this. So that's one other reason why we're actually underweight on Europe. People have sometimes asked me, you're optimistic about a lot of things. European equities, and I'm sorry, I'm from Europe. I have to admit that, this is the area where we're less optimistic. You still have inflation. You have a central bank that is a little bit more, hawkish. It is not going to cut interest rates that quickly. You have fiscal issues as well. So that would be a market that we're still underweight at this point in time. Once we get more optimistic about the global cycle, China would be great, obviously, for Europe. If China accelerated, then we could upgrade, Europe as well. But for now, an underweight.
Thanks, William. So maybe the next one, let's go to James. And I'm going to ask this, I think, for most of our audience here, being Malaysians. How do you view Malaysia as an investment destination? And what do you see are the key drivers or the catalysts for Malaysia to gain more prominence in the investment community?
Yeah, well, I'm an analyst looking out and looking in. I see the data. In my interactions, I meet a lot of Malaysian businessmen. I think the outlook for this year, to me, looks a little bit better than last year. We've penciled in Malaysia to grow about 4.5%. That's better than last year, around 3.8%. I think on a few factors, consumption is still fairly strong here. And also, I think that tourist recovery, somehow Malaysia is capturing much more Chinese tourists than even Thailand. And of course, we know that Chinese tourists is not going to recover so fast back to pre-pandemic levels, but I think that's improving in Malaysia's case. And also another positive factor would be that whole improvement in the electronic cycle. I think Malaysia would also benefit from that. And of course, from that perspective, that growth, that prominence, what you have is that multinational companies, because of supply chain diversification reasons, is looking at Malaysia, considering Malaysia seriously, and you have seen a lot of FDI pipelines here. So I think the outlook is brighter. Of course, there will be challenges along the way, but I think this could be a good year for Malaysia.
Sure. Thanks, James. I'm just going to pivot back to William for a quick second, and this next question has 2 parts. So the first part, it's on the growth potential. You spoke about AI, artificial intelligence, and that's the key buzzword in today's era, right? So how does a retail investor leverage on this and benefit from their portfolio?
Mm-hmm. Yeah. So,
and I come to the second question.
I was looking for the second part. So on the first part, how can people invest in it? Again, trying to broaden your perspective around this, because I've mentioned, obviously technology itself is going to There's a chips part of it. There is a cloud part to it as well. Data centers are linked to this because we are all getting more data intensive, right? Going to work with that. So that's the infrastructure in a certain way. Then there are the software companies that are going to allow us to, work with that data and to optimize, what we want to do. And so the third element is the more difficult one and the more sort of, bottom-up stock pickers, question, where you're going to say, which companies in almost any industry is going to benefit most from this. And I've given the examples of the healthcare industry.
Yep.
I've given the examples of the industrials as well, but you can look at it in the financial sector as well. How are we going to use AI to get more productive? Now, that's an analyst job to see which, CEO and COO is going to use it to their advantage.
Okay, right. So the second part of the question is, again, circling back to one topic that you mentioned earlier, which is about political or geopolitical uncertainties. So I guess the question here is how can one protect their portfolio in terms of mitigating the risk or the uncertainties that is coming through from the political or the geopolitical uncertainties?
Yeah, so I would refer to, number one, the election calendar that we've shown.
Yes.
A lot of them will be non-events, right? And so therefore, then you can wait for it and again, be out of the market, try to time it, and miss the opportunity. The second thing is, not only do you have to get the timing wrong, you also have to get the direction right. Even if you have Trump as if it were to be Trump, you guess Trump, then what are his policies going to be? So there are so many variables that you can only ever hedge yourself imperfectly, and again, you're going to miss opportunities. The way that we do it, that we think is much more reasonable, is to build a solid portfolio that you can weather some volatility. If you then have surprises, you can still, after the fact, tweak a little bit, but at least you've weathered the volatility that you've had by building that diversified portfolio of quality assets.
Right. Thanks, William. Then, Alvin, for gold, some people think slightly, but so some people view gold as like a currency. What's your view on gold, especially in times like this, as a safe haven?
Yeah, I think gold price have risen quite a fair bit, I think, end of last year and also I think in some parts of the year before. To some extent, I think, the high inflation situation, safe haven, as you say, has also put gold as a preference in terms of another so-called asset class. I think the likelihood is that the view on gold is that it may likely retain its value, but is there any more upside swing as what we have seen the last 1 year? Possibly not. So it is a good asset to hold, but in terms of greater appreciation, perhaps that's not likely to be the case because inflation is already start coming lower, rates are coming off, and perhaps confidence in terms of sentiment is also likely to be improved.
Right. Thanks, Alvin. And yes, so there's a question here. Many of us are unable to invest in individual stocks. How would you construct your model portfolio in terms of region, in percentage? And maybe, William, would you like to kickstart this? Or James, for a change?
Yeah, well, I think first and foremost, there is no one size fits all for everyone. The starting point would be your own risk profile, what objectives you want to reach. But I think in terms of broad stroke, for a moderate risk investor, you want it to be roughly around a third in equities, global equities, a third in global bonds, and perhaps a third in alternatives like commodities, gold, and some of the asset class that don't correlate as much as with your public markets. So these are just broad strokes, but within which you want to see some kind of customization that you want to put, whether you want income, you want growth to give you that outcome that you want in terms of your own financial planning.
Thanks, James. Okay, we don't have this. Now, I apologize if I'm going to put anyone on the spot here, but I think we're getting to the part of the session where I think the audience would really like to hear. So if I were just to ask, what is the one thing that keeps you up at night?
This
It can't be Netflix, right? Professionally, you mean, yeah?
You want to go?
I can start it. Yeah. So again, lots of things can cause volatility, but the only thing to me that can cause the market to deviate from the bullish case is U.S. wages, because that is really what the Fed is looking at. So I'm looking at the U.S. labor market every time, because if that is not coming down, and so in particular in the services sector, you need that inflation to come down. That is the only thing that could change the Fed's view, and therefore the only thing in my view that could keep the market from rallying. So we're eagle-eyed on that. If we change our mind on that, we will let you know. But for the moment, we are very optimistic.
Okay. Everything to James?
In fact, every morning I check the oil price because not because of pump in the petrol, but Middle East. It's just that oil price hasn't reacted to anything there. I mean, because supply chains were not affected, etc. But it's very fragile. Anything can happen. None of us could predict. So I always watch oil price. And another thing I'm watching out for is Trump. You don't? He used to tweet, so he stopped tweeting, and he has his new platform. Have you downloaded it? No, I'm not advertising for it, but it's called Truth Social. I mean, just to keep track of what he's saying. So yeah, I'm watching out on Trump as well, every morning, every night. That keeps me awake. Entertainment most of the time, actually.
And Alvin?
Well, I would say it's somewhat similar, but basically it's geopolitical risks. You already have the two largest economy having trade tension and so forth that is likely to continue. You have tension in the Middle East. It's just a question of just whether things will improve or escalate further. That's something that is worth watching.
Yeah, and I guess for me, it's really more of inflation. What if it kind of surprises or where it becomes stickier than what consensus is? And I think that would probably also derail quite a bit of the base case expectations for rate cuts. So inflation, unexpected spike or reflux of the inflation figures in the US.
Right. And then turning to a more optimistic or positive tone, what is your one highest conviction?
Bonds. I think putting your cash in bonds, shake it off, right? Shake off the cash.
Shake
off the cash.
Shake it off.
Shake off the cash and go into quality bonds. That's my number one conviction.
Mine is AI. ASEAN, India, not AI.
Same bank, so house view is the same. Bonds.
So I guess the consensus view is bonds are back. And I think from an opportunity perspective and based on the topic that I spoke about today, India fixed income, it might be very new to, I think, global investors, especially and potential investors that we see in this space. But I do think that given a lot that has been shared by James, as well as from a currency perspective, I do think that that's probably one of the brighter spots in the fixed income space that we should be really looking at.
That's interesting. Okay. James, you mentioned about tech sector. I think in one of the earlier slides, you share about the market performance and how the US was mainly driven by the tech run last year. Do you see this trend spilling over to Asia?
Yeah, well, I think a lot of last year was a year of AI. The companies that are associated with AI or owns an AI model did very well or provide the infrastructure associated with it. Therefore, the rise of Super Sevens. But I think in many ways, many of the tech companies in Asia are also slowly improving. It might not be as powerful in terms of owning those models, but they are also building it. Likes of many of the big companies in China, for example, they have their own AI tools, their own AI models. So I think that's going to be a big driver as long as it drives efficiency, it helps make consumers better decision, it drives efficiency for companies, productivity. I think it will do very well. So I suspect that it's going to be a year where you're going to see not just the companies dealing with AI doing well, there will be slowly a broadening out of it. And that will play out not just in 2024, but also 2025, where non-tech companies also benefit from what AI can offer. And it's not kind of limited within the Super 7. It's broader than that. It's big companies in other sectors, in various geographies, and of course Asia included, because we have the largest growth potential, we have the largest consumer market, and clearly it's a place to apply, and clearly a lot of opportunities that AI can offer for Asia.
Well, yeah, and so AI obviously is about data, so you need a big source of data. And guess what? I mean, in China, there is a lot of data, at the disposal of the government and of the bigger companies. So I think that is going to be their competitive advantage there. In the US, obviously, you have those magnificent seven that are a creator of, lots of the innovation. Again, it's in Europe where the real question is, where are the tech champions there? But I think the race is on between the US and China on this.
Yeah, sure. Well, I would love to continue, but I just received the cue that we need to end. We don't want to keep our guests back for too long. Maybe just one last question. And so who will be the lucky one? So maybe I'll go to Alvin. Just one last question. See, driving into the office this morning, I heard the radio. It was talking about the ringgit, Sing dollar especially. I think it's basically near the record high or close to it. So I guess from our perspective as local investors, whereby most of our commitments are all in ringgit base, so should one be holding their assets in ringgit? And if not, then how should they diversify their portfolio from a currency perspective?
Well, diversification has always been a hedge against volatility. That continues to be, I think, a case in any investment principles. As to exactly where to go to for now, I have shared that we are mildly bullish on the ringgit this year. So to diversify out now, you may have been catching it at the tail end of that diversification. If anything, I would say look into diversification in terms of asset class rather than currency from ringgit base. And there are certain type of participation where you want to get access to certain underlying assets in foreign currencies, but there's also ability to manage the currency on a hedge basis. So there are many ways to think about diversification of assets and investments out of ringgit. It could be on a hedge basis into selective underlyings that has potential for growth.
Thanks, Alvin. Okay, and with that, I would like to very much thank you to the panel, the speakers, for their insightful views and sharing.